right. Good afternoon, everyone. Thank you for joining us today. If you haven't been on one of our webinars, my name is Katie Gascoigne. I am an outreach coordinator with the Human Services Center Mon Valley, and we're conducting this as part of our financial literacy program. You may have heard on your way in that this is being recorded, so you will get a copy of the video later this week. So don't feel like you have to frantically write down all of the notes. You'll be able to refer back to it and play it as many times as you need to. And I am joined today by Regina of the Allegheny County Financial Empowerment Center. They got a brand new name recently. It used to be Pittsburgh FEC, now they're Allegheny County FEC, but they still provide all of the same wonderful services. And I'm sure Regina will talk about that a bit more.
Again, my name is Regina. I'm with the Allegheny County Financial Empowerment Center, and we were until the turn of 2024 the Pittsburgh Financial Empowerment Center. Everything's the same counselors on staff, the same great service. We've just changed our name, and I'll talk a little bit more about that as we move along. The overall gist of what we do at the Allegheny County Financial Empowerment Center is we, as a public service, offer financial counseling to anybody who's over the age of 18, and it does not cost a penny, righty? But again, towards the end of this, I'll tell you what we do, how we do it, how we're qualified to do it, and so on. Okay, so here's what we're looking at. We are looking at how to utilize your tax refund. And this is our rough agenda for today. We're talking about anticipating your funds, setting goals, tracking spending, building a budget. And I know this is not a budget talk per se, but there's a reason why a tax refund is more effective if you already have a budget before it shows up. Starting good habits, paying down debt, which I suspect some of you have questions about, and just as important, and what I see as the finish line, saving for future fun rather than things that we've already purchased. As Katie wrote in the information she sent out on this, it is spot on. For most every single American, it's not the bulk of the money we have coming in a single year, but it is the biggest lump sum that we'll receive in a typical year. I know there are exceptions to this rules. I'm not a gambler myself, but this is something that most of us keep an eye on and plan for in a typical year. So this is kind of a silly slide, but just to be clear, because some people get refunds and some don't, and there's a little understanding why, but really what it is a refund is the government paying you back for money, excess money that may have been paid out in taxes to the federal or state government. So if any of you are in the habit of looking at your paychecks, you'll see that what you get before taxes is called your gross. And when you look underneath there, you'll see that taxes are taken out for Social Security and federal and local and city taxes. So basically, that amount is taken out of our paychecks. And for a lot of us, too much is being taken out of our paychecks. Some of us, not enough. But think back to your early days of being employed. You had to fill out what was called a W-4 form. It's not a particularly fun form. It's a little confusing even for the best of us. But that W-4 form tells your employer how much to take out for taxes. All righty. We do it one time, but you're really supposed to do it at least once a year or when a personal situation changes. So if you're a single person, a different amount is being taken from your paycheck than if you are a married person, or if you're somebody with 3 little ones at home. So anytime there's a divorce, a baby, second job, a marriage, whatever, you should always update your W-4 forms. There are those who look at this as a science. Some people like to have too much taken, so they get a ton of it back in the spring. Me personally would prefer to have the right amount taken, because why should the government be holding on to my extra money for a year just to give it back to me? I could use it on a monthly basis. We'll talk a lot more about this if anyone has any particular questions, but that's what a tax refund is. It's just that reimbursement for the money that was taken out. So let's say have our fingers crossed that we're hoping to get a refund. With that big lump sum of money, you are in a position that if you use it strategically, you can really change your overall financial situation. I always think of it as your finances as you're in a boat, and boats go kind of slowly, big ones do. And a tax refund is an opportunity to start turning that boat around quickly if it is used strategically. But let's be realistic. This is what a tax refund is. Somewhat unreliable. Very few of us get the same amount every year. You're not sure how much you're going to get. You're not sure when you're going to get it. The amounts change. Some years you owe, some years they owe you. And as some of you know, and Katie may want to share more information about this, tax laws change from years to year. What's a write-off this year may not be next year. So it is unreliable somewhat. That's why it's really important to have a good understanding of your regular, consistent income. If you get a paycheck and it's the same every 2 weeks or every month, or even if it varies a little bit, that's the thing you want to have a grasp on. Because without a budget, even with this nice big fat tax refund, without a budget, most of us will overspend and undersave. No doubt, even the pros will do that. So I kind of like to look at your tax refund like a bonus. It's not actual income. You're just getting something back. And as I said, some years it's big, some years it's little. Ideally, again, this is our finish line. We want to use that refund to save and pay for what's ahead rather than for what we've already spent. A lot of us get that tax refund and say, oh, good, I can pay off the stuff I bought for Christmas or last year's vacation. What we want to do is try to start focusing on saving it so that we can tap into it to buy Christmas. And that way it actually avoids debt in the long run. So foundation of it all is keeping track of your consistent spending by tracking that. All it really is it's writing down your income and your expenses as they happen. Alrighty. And the idea here is you get exact amounts. If some of you have already filed your taxes, you could probably get a month worth of tracking in before that refund shows up. And if you haven't filed yet, this is a great time to start doing this. Basically, you can use any number of methods. Old school ones, which I'm partial to, you can use a spending journal, a spending tracker, a planner. I've got a number of them that I share with my clients where basically at the end of the day, you write down everything you spend. $27 in gas, $14 at Burger King. You do it every day, save receipts, look at your bank app, and then start over fresh the next day. You're doing this for you, not for somebody else. You just need to find out where your money's going. An old school way, as I said, is with pen and paper. There are tracking apps as well. Pocket Guard, You Need a Budget. Mint is on here, but I wouldn't recommend them anymore because they were just bought out by some predatory people. But there are lots of apps that you can download on your phone, connect it with your debit cards and credit cards, and it basically will keep track of everything you spend that day. Kind of like having a little account in your pocket. You can also use a calendar method. I know a lot of folks who, and I'm not sure how visible I am, use just an old-fashioned calendar. When they get home at the end of the day, they write down what they spent. The idea is to find out where's your money going, because again, most of us tend to underestimate what that amount is. I have a lot of people who insist they only spend $40 a month eating out, but once they start to write it down and add it up, they're spending hundreds of dollars eating out. So this is for you. This is not for anybody else. This is just to find out on an average basis, my average income, my average expenses, how am I watching my money? Once you do that, then you kind of want to look at your individual columns and decide, what do I need? We're all different. Everyone on the planet, we're all completely different people, but there's a difference between needs and wants. And this little list here, rather than even bother with the check marks, I suspect you could all look this over. There are needs and there are wants and there are variables. Like at the very bottom, clothing. We all do need clothing, but do we need, $127 sneakers, or can we get away with $5 ones? I'm a $5 hand-me-down kind of girl myself. But anyway, if you look at over your spending, the needs are always the things that keep the roof over your head. Rent and mortgage has to be the first thing that goes out, followed by utility bills, and then usually your transportation, car payment, and that kind of stuff. There's so much flexibility in our spending that once we write those numbers down, it's important that we categorize them and analyze them. Once you decide what your needs are, as you can see, keeping the roof over your head, putting food in your belly, getting you where you need to go. I'll say this quickly about groceries. That's also, although it's a need, it's really variable, whether you're eating at expensive restaurants every week, every night, or if you're shopping at Aldi or even using the food pantry. That's flexible, but it's important. You got the needs and the wants. And once you take a look at what you are spending, it's kind of good to separate those items because your needs, all of us, our needs should not be more than 50% of what we have coming in. Okay. So if I'm making $1,000 a month, my rent, my car payment, my insurance, that better be under 500, which isn't too likely, but still 50% of what you're spending is in the needs category. 30% is in the wants. So that's flexible. And that's the amount of this little pie chart that can close a lot. If times are tough, as they have been for me in the past, I put myself on a spending freeze. I am just not going to go out to eat this month if I need to save money because of my car repairs or something like that. So one of my coworkers, just a little side note, made a great little tool with this, which we share with a lot of our clients, that when they track their spending, whether it's on a piece of paper or on an app, if they plug it into this little tool, it shows you how much goes into the needs column and the wants column. Because when most of us start out doing this, our needs are very often a lot more than 50. Our wants are sometimes greater than our needs. And many people are never saving at all. Saving should be at least 20%, at least, of what you have coming in. And this savings is not just going to be putting money aside and forgetting about it. That savings has a job, okay? And that job is paying down debt. And even after we have savings that we need to pay that down, we want to continue saving so that we can decide if we're going to spend a week on the beach this fall. And if we are, it's coming out of that savings account. We don't have to worry about how am I going to pay for the hotel room. So moving on, tracking your expenses, analyzing your expenses. And as a tip, ideally, you want to keep your housing costs, and this is a tricky one. I will agree with you all. You're thinking this. You want to keep those under 25 to 30% of your income. Now, I know I had mentioned at the beginning of this that your gross income is the amount that you make before taxes. And then once your taxes and your insurance and that stuff takes out of it, what you're left with is the net. And the net is the number that we use to make the analysis of 50% needs, 30% wants, 20% savings and paying down. So that 25 to 30% housing cost is tricky, I will admit, especially with rents rising, but there are ways around it. There's a way around everything, honestly. So I'm going to talk a little bit more about that 20%, which is not easy. Obviously, paying the rent's important. A lot of people say, well, I just can't save this month. But paying your savings is just as important as paying your rent. It really is. Because if you can make a habit of savings, and this is why that tax refund is a phenomenal opportunity to kickstart your savings program. If you can make a habit of doing it every week, every month, every paycheck, ideally, it becomes a habit. And just like brushing your teeth when you were little, when you learned how to do that, and you hated it when you were a 3-year-old, but now you're on the habit, you've got beautiful teeth, and it gets to be an easier thing every time. I think this comes up in a slide in just a little bit, but I would like to just point it out that the ideal way to save is obviously the easiest way is always the ideal way to save. But if you get a paycheck, your payroll department, again, you filled out your W-4, you told them about your bank account so that your paycheck goes into your bank account. Your payroll department can deposit your paycheck into your checking account, and they can take $10 per pay or $20 per pay or $30 per pay. They can put it in a savings account for you. All right. Payroll departments can actually split your check up 10 different ways if you want them to. But the nice thing about saving before your check is even deposited into your account is that you don't miss it. Okay. one of my favorite quotes, and I'm not a quote saver, but I love this quote by Warren Buffett. It's that don't save what's left. And that's what a lot of people do. When I asked if they save every month, they say, well, if there's something left, I save. But ideally, you don't want to save what's left after spending, but spend what's left after saving. So if your payroll department puts $25 per pay into a savings account and you don't even notice it, by the end of the year, you're going to have $850 there. And you never missed it because it never showed up on your regular paycheck. So making a habit of savings is what's really important. So let's say we track your spending and you have everything in place, your rent is here, and you're going to cut back eating out or gambling or something along those lines. Time to start savings. Let's talk about that little 20%. And don't worry, we're going to get you a tax refund because this is where it all starts. When you start saving, ideally, the place to save is not in your sock drawer, not under your bed or under your mattress. Okay. Two big options are traditional and online banking. So a traditional bank is the one that's at the end of the street. You can open up a savings account with a bank. I'm a great fan of credit unions myself. And as I mentioned earlier, think about having a small amount automatically deposited, because if you make work of it, if everything goes into your checking account and then every Friday you have to go down and transfer it, some Fridays you're just not going to want to do that. So have it automatically deposited. It's easier. And it's always easy to start small. Okay. Like I said, $10 a pay. Some folks have great gusto and enthusiasm. They say, I'm going to save 200 per pay. But if you have to tap into that savings account, that means you're saving too much. Okay. Ideally, savings gets put aside and you don't touch it until you need it. So always start small, like $10 a pay. And as I said earlier, you're not going to miss that money because it was deposited before it even showed up. Now, if you get a tax refund, most of us, fingers crossed, that refund's going to go into your main bank account, which may be a checking account. Ideally, if you can, slide it into your savings and let it sit there until you decide what to do with it. If you're planning ahead, if you know what you're already got in mind, you can also put your savings in an online high yield account. This is something that I will admit, like 5 years ago, I was really skeptical about online accounts, but they are actually terrific. They pay much higher interest rates than the bank down the street. All right. And it's mainly because they don't have to have a building and an electric bill and that kind of stuff. Online high yield savings accounts, you can look that up very easily. They all have fine print that say, minimum $100 deposit, something like that. And some of them want monthly deposits too. The other nice thing about online high yield accounts is that if someone says, come on, let's get a Red Lobster tonight, and you just don't have the cash on you, if you're at your bank, your savings is in your bank, you can go through the drive-through and get it. You can't get your online savings out quite so easily. It's yours and you can get it, but there's usually a little bit of a turnaround time. That's why savings in an online account is actually a little safer from us, but it's still our money. It also is and should be backed by the Federal Deposit Insurance Corporation. All banks, traditional banks are. And the FDIC means that up to $250,000, if something should happen to your money, you get it back. You're safe. Okay. So make sure that if you look at online savings, they're backed by the FDIC. The other thing too is if you are really mapping things out, you can think about a CD, a certificate of deposit. A lot of local banks have those, and they're getting really kind of competitive now. The rates are a lot better than they used to be. You can get a 4-month CD that pays a high interest rate, 9-month one, 12-month one. You can even get a 3-year one. But what you want to do is you want to put your savings in a place based upon when you're going to need it. Okay, because if you get a CD for 9 months, you're not allowed to touch it for 9 months. If you have to get it out early, you pay a penalty. So ideally, when I talk to folks who want to think about investing in CDs, if they're thinking about spending next April in Jamaica, the whole month, I say put it in a 12-month CD. That way you plop it in there, it's earning interest for 12 months. And as soon as the CD matures, you get it out and Jamaica is paid for. Okay. Subtle difference here is CDs, you put one chunk of money into it. You don't keep adding into it. Whereas online accounts and traditional bank savings, you can add to it weekly, monthly, whatever. Any questions just yet? Katie, shout at me if there are.
So far, nothing in the chat.
Okay, so far so good. Okay, now let's say you get your tax refund. Let's say you are actively saving and you save your tax refund because you want to make a plan with what am I going to do with this money? All right. For many of us, what we want to do with it is pay down our debt, and we want to pay it down so that we can kind of have a clean slate and move forward. And we also want to break some habits too. A lot of us run up our credit cards and we wait for that tax refund to pay them all off and start with a clean slate. But let's be strategic about this. Let's talk about paying down the debt, which ones we need to pay down, which ones we want to pay down. Yes, there's a difference. And still saving so that that debt does not accumulate this time next year. Next year, wouldn't it be great if that tax refund was all in the bank? So debt is basically owing somebody something, but some debt is more important than others. So, and think about your own debt in your head as we talk about this. You want to organize the kind of debt that you have. There's two basic kinds: secured debt and unsecured debt. Alrighty. And I would ask this question. I don't know if anyone feels like shouting it out, but one of these two kind of debts is a little more dangerous than the other. And that's actually the unsecured debt. Okay. Now, secured debt is high risk, but it's also so important that most people don't fiddle around with it. All it really means is that the debt itself has an item behind it. I'm sure you all know this, that if you don't make your car payment, what happens? They come and get your car. If you don't make your house payment, your mortgage payment, after a few months, they foreclose on your property. So that is the priority kind of debt. In order to keep what you've got, you need to pay that every month. Unsecured debt, I promise you, is not as important as secured debt, but they harass us more than secured debt holders do. All right. Unsecured debt are credit cards, medical bills, things along those lines. Even student loans, I'm sorry to say, is unsecured debt. Basically, because if we miss that payment for your credit card, they're not coming back into your sock drawer and taking your socks out that you bought. They're not going to take your diploma off of the wall. Now, it's still important to pay those. And as I said, because of the nature of those debts, they have the ability to kind of harass us in a way that mortgage companies and car lenders don't harass us. Years ago, when I was a foreclosure counselor, and if somebody would come to me with a foreclosure or a sheriff's sale notice, my first question would be, why didn't you pay your mortgage? And it was alarming how many people, lots of them, would say, well, I had to pay that credit card because they kept calling me. Your credit card is never more important than your secured debt, your house or your car. All right. So first you think about, these are the folks I owe money to. And then you separate them, secured and unsecured. And then you want to take a peek at your credit reports. I'm going to give a shameless plug right now and say that at the Financial Empowerment Bureau, we will pull your credit report for you when you meet with us. The pull that we do is called a soft pull. But one of the other great benefits to having us pull your credit for you is we give you the score and we show you how to read your report, because Equifax, Experian, and TransUnion don't make it easy. There are 3 different reports, 3 different numbers. They have 3 different formats too. And reading some of them is enough to make your head spin. Okay. Now, when you get on annualcreditreport.com, this is the only site you would ever use to check your credit report. You would pick Equifax or TransUnion. You just pick one of those bureaus. Take your turn, take time with them. Pick your TransUnion one first and put in your personal information. It will give you your TransUnion report. It will not give you a score, but right now you're not looking for a score. You're looking for numbers. You want to know, how much do I owe on this credit card? How much do I owe on my car loan, and so on. Now, the reason I suggest you just pull your TransUnion one, for example, first is because you actually get 1 free report each week from all of these guys. So let's say the end of this week, tomorrow after work, pull your TransUnion report, get your tallies and see how much you owe on your Pennies card and your Target card and your car loan. Next week, pull your Experian one, compare the trade lines, make sure that they're all the same, make sure that one doesn't say you have a Bank of America card and you don't, and compare the totals. Alrighty. So you'll want to access your credit report, look at the trade lines on your report, and then you're going to want to write down the totals that you see on there, depending upon who you owe and how much you owe. And as I mentioned, they're all slightly different, and we can talk more about the details and the differences in the credit reports if you all have questions at the end of the presentation. But you're going to do this to get a listing of your debts. Now, just so you know, if I borrowed money from you all and I owe all of you $200, it's not going to show up on the credit report. A debt is anything you owe anybody, including your Uncle Fred or somebody else. But your Uncle Fred doesn't report to Equifax, Experian, and TransUnion. Just national lenders usually do that. So there could be debts that don't show up on these reports. But after you pull that credit report, you're going to make yourself a list on a piece of paper, preferably. You're going to write down the name of your creditor. Here's your JCPenney's card, here's the Wells Fargo card, here's your Target card. You're going to write down the balance that you owe on that card. You're also going to want to write down, even though it's not there listed on this page, your credit report shows you how much you owe, but you're also going to want to know what is your credit limit. So if you owe $2,500 on JCPenney's and your limit is $3,000, you're going to want to make note of that, okay? You also want to write down what is the minimum payment. I bet you all know that when the credit card company sends you a bill and tells you that you owe $14 this month, that's the minimum amount. And that's all they really want you to pay. And the reason they want you to pay just that is if you pay the minimum, they're going to keep charging you interest and the balance is going to get bigger. So the name of the credit card company or the car lender, how much do you owe as your balance? What's the minimum payment they want? What's the due date? Now, if you have a car loan, a mortgage, the remaining term. So I only have 2 years left to pay on this car. Credit cards don't have a term limit, okay? Credit cards, you can keep those things, but for 40 years. But if it's a car loan, a mortgage, a personal loan, write down when you're going to be paying it off, okay? This one, one of them you might be paid off at April of this year. Another one, maybe another 3 years. And finally, the red box on the bottom left is probably the most important thing that you need to write down. It's not on your credit report, though. I don't know it. Your financial counselor doesn't know it. You will find the interest rate, the APR, at the top of the statement that your credit card company sends you every month. All of our credit card bills, guys, mine, yours, Katie's, everybody's, they all look the same. The top of your credit card bill has your name, tells you when you open that credit card, tells you your limit, tells you what interest rate they're charging you. It could be a 0% interest card. It could be a 7% interest card. It's more likely a 32% interest card because credit card companies can change their rates. They have to notify you in advance, but credit card rates can be gigantic, okay? If it's a car loan, your rate is probably going to be the same until the car is paid off. Same with a house, a mortgage, okay? And personal loans too. But that APR is going to be a very important thing in the column. So you're going to have a column with who's my credit card company, what's the balance, and so on. And what's going to happen is you're going to end up with a little list like this. Now we're going to spend a little time here. And if anyone has any questions, and I don't mind going back and doing some math with you all, okay? You're going to have a list of, these are my 4 cards. This is my credit limit. This is my current balance. Now, there's a column there that I didn't tell you to make, don't worry, because what we want to do ideally is make sure that we never use more than 30% of the available credit on a credit card. So if we're looking at my imaginary Capital 6 card, what I do is I have $3,000, that's my credit limit. If I want to know what 30% of that is, times 0.30, and that's where I get $900. So when my balance gets down to $900, that's when my credit is going to pop up, because when we have high credit card balances, your score drops dramatically. If we can pay these guys down to 30%, our credit improves and we start saving money at 30%. I'm sure you all know this, though. Ideally, we want to pay them off completely. Okay. So the Capital 6 card, let's say I got my imaginary balance off of the imaginary credit report. I got the APR off the top of my statement. They're charging me 17%. And when I did the calculations, I want this card to get to $900. So I subtracted the current balance, $2,437. I subtracted the $900, and that tells me if I pay down $1,537, this car is going to be at 30%. Okay. I did that with all these other cards. As you can see, my JC Pancake card, there's no balance on it. It's beautiful. It's got a 12% interest rate, but if there's no balance, I'm not being charged. If there is a balance, you are being charged. Okay. So just by looking at this, the numbers are going to tell you what to do. Which credit card costs the most? Does anyone want to shout out? You're allowed. The 22% Wells Fargo card costs the most because it's the highest interest rate and the highest balance. So that's a monster we're going to want to get rid of. Okay. Which card's the easiest one to pay down? Well, probably the Discovery card. It's the lowest balance. It's the smallest pay down amount. Okay. Paying down the highest interest cards will save you money in the long run. Okay. What I would suggest to this imaginary client with these 4 lines of credit, all carrying balances, is to pay those down. And then what you would also want to do is why don't we limit how many credit cards we have? Most of us don't need 4 credit cards. It's not bad to have them, but do we really need to use 4 of them? Probably not. I would say, you know what, to my imaginary client, pay down. That JC Pancake one's, it's in good shape. How often do you use it? Well, I don't use it much. Put it in your sock drawer. Seriously, don't close it. Don't cut it up. Just don't use it. You don't need that temptation. It's saying spend money that you don't have. That's what credit cards are telling us. Okay. Now they might say, I love that Discovery card because it gives me points back, but it has the lowest credit limit. But there's some pros and cons to all of these. If that Discovery card gives you points back and cash back and airline, all that kind of stuff, if that's really your favorite one, even though it's only a $750 balance, that actually might help you stay in budget. Okay. That Wells Fargo card, and this is a trick some of you have probably seen, your credit cards, when they see that you're paying them down or when you're getting close to maxing them out, they'll increase your credit limit. They're not doing that to be nice to you. They're doing that because they want you to come and spend more. Okay. So that Wells Fargo card, because of the high interest rate, the high balance, I would definitely focus energy on paying that one down and putting it away. That high credit limit will help you. It helps your credit stay good. But if you're not using it, it helps you even more. Okay. So making yourself a chart like this with the information off of your credit reports, as well as the information from the top of your statement that tells you what the interest rate is going to tell you where to focus your energies. If any of you follow financial information on TikTok or social media or read about it, there are 2 common methods. Neither is better than the other. Okay, they're called the snowball or the avalanche methods. These have been around forever. Okay, there's not one better than the other because we're all different people. Some people like the snowball. Focus on those little ones. Pay off that little account, even if it's a low interest rate. Pay it off, but get it out of the way. Okay. It's like if you're in battle and you've got like 5 people coming at you on the battlefield, knock them out one at a time. Then you're down to 4, then you're down to 3, then you're down to 2. Okay. If you pay the smaller ones, it's a little easier and you feel like there's small successes. If you pay the avalanche method, the highest interest rate ones, it's no fun because it costs more money usually, but you start saving faster because you're not paying interest. Okay. So if you knock out the high interest rate ones right away, you will save on interest charges. Back to your credit card statements, guys, which look, again, just like mine. Remember, it says your name when you open the card, what your limit, what your interest rate is. It's also going to tell you, here's how much you sent us in interest already this year. It's actually heartbreaking. It may be enough for you to fall out of your chair when you see how much you're paying in interest without even realizing it. Okay, so look at your credit card statements, look at your credit report, start that chart and decide, here's how I'm going to pay these down. Okay. Bad advice that's out there commonly is credit card companies tell you you're supposed to keep a balance on your credit cards. It helps your credit report. It's not worth it, guys. So the only ones who really benefit by you keeping that balance on there are the credit card companies, because even if it's just a $2 balance, they charge you interest on it. And it's like you're never going to pay that bill off if you always carry a balance. Some people who like to think they're like really getting into the weeds with their credit report and want to make their score as high as possible say, well, I always try to carry over a certain percentage. I say, don't do it. There are other ways to have a great credit score without giving money to the credit card companies, because that's what we do. We carry a balance. You're just handing money over to Visa and MasterCard. They don't need our money. We need it more. So don't ever carry a balance. We're aiming to pay them down to 30%, but then, I neglected to say this, the last slide, we're aiming to pay them off completely. Pay them off completely, put it away, okay? We'll talk about them possibly closing cards if anyone has any questions with that. So if you get this tax refund and you put it in there and you make your chart, you pay down those high interest credit cards. But the fact of the matter is you might still be struggling with debt. It may not be enough to pay everything off. But let's say you can knock out 2 credit cards, even if you still have 2 with balances, okay? There are still ways around it, and you will benefit greatly by paying off the high interest ones as quickly as you can and just getting them out of your reach. So for the here and now then, going back to a regular budget. All righty, let's put the tax refund to the side for a second. All right. In the short term, there are ways of minimizing expenses. And I know that when I showed that little wants and needs chart, one of the biggest things that get almost all of us in trouble is eating out too much. And very often what we think we're eating out, the dollar menu is not a dollar anymore. Okay. So short-term sacrifices, you know what, why don't we have something at home tonight instead of ordering out? Or instead of going out with your friends and meeting them there at a bar, just say, everyone grab a cheap bottle of wine and come on over. So you can have, you can conserve your resources, but you can also have a short-term sacrifice. I know I mentioned that I put myself on spending freezes all the time when I have to tap into savings and I want to rebuild it. I don't buy anything that month. I'm not going to go out hungry. I'm not going to go cold and naked. We're all good. You can conserve sources by carpooling, combining chores. I do that all the time. I work out I work out in the field 2 days a week. I work at home a couple of days a week. The days that I have to go to an office, those are the days I stop and do my grocery shopping and pick things up. Shop for lower priced internet, even though the Affordable Connectivity Program is on its way out. Hopefully we'll try to make it come back. There's still cheaper internet, cheaper cell phones, food banks. There's all sorts of options. And then the other thing too is always keep those priorities in order. Your needs have to go before the wants. The rent, the car payment must go before the credit card, no matter how annoying they are. So make sure you prioritize those things that you need to really to survive. Your car note, especially if you need to get to work. And then the other thing too, if push comes to shove, I often recommend to clients, give your car lender a call. Let them know that you were laid off for a few months. Car lenders have the ability to, most every lender does, actually. Credit cards have the ability to work with you as well. They can temporarily lower your interest rate. Car dealers can give you a deferment. They can give you 6 months off. So that's okay. Just hold on, once you're reestablished, start making your car payments again. And instead of your loan being paid off in January of next year, it'll be paid off in June of next year. They can do that. You can always ask. And again, always pay secured debts before unsecured debts. The other reason too is once they start proceedings to either take your house or your car, then they incur attorney's fees. So it costs more to catch them up in the long run. That's a worst case scenario kind of thing. But let's say we pay down those cards. We have money in savings for next year's activities. What you want to do is you want to stay debt free. Okay. And if all of you think about it at this point in time, if you get your tax refund, make yourself a chart, pay everything down, make sure that there's enough set aside for an emergency fund. Because no matter who you are, where you live, who you live with, emergencies always happen, whether it's the radiator in the car needing to be replaced or the hot water tank in the basement gave up, blew up, it's a medical bill, all sorts of stuff like that. Build an emergency fund. There are formulas for what that should be: 2 or 3 months worth of rent, 2 or 3 months worth of mortgages, that kind of stuff. But if you handle this the right way and make a plan to get out of debt, you can use your tax refund to pay down your debt, put a chunk of it aside, and then with that same plan, start paying down the remaining debt. If you still have one credit card you didn't tackle yet, tweak your budget so that you say to yourself, I'm going to have that last card paid off in April, and then everything from that is just going to go into savings, my emergency fund. The middle box here, really, I cannot emphasize how important this is, using credit wisely. As I said, I am truly a big fan of just identifying which card do I like, which one gives me cash back, which one has the lowest interest rate. Some of you might discover that you have a 0% card that you never knew about. That happens like almost every week when I talk with clients. Okay, they had no idea. But what you want to do is you want to restrict how much you can spend. That's why it's nice to carry a credit card that only has a $700 balance instead of the one with a $10,000 balance. Put that bigger balance one back in the software. That $700 balance card, you can use it every month and only use it if you can pay it off every month. Okay. Give yourself that little goal, and a little card makes that easier. Okay. A low balance card, low interest card, low limit card. Sorry. So only spend what you know you can pay off in full at the end of the month. If you don't trust yourself with a credit card, but a lot of people do this, get all those cards out of your wallet, put them all in your sock drawer, but just one of those cards, why don't you auto pay your electric on it so that $100 a month gets charged to that card, and then you pay it off every month too. But you're not walking around with it. You're not tempted to go into TJ Maxx and start swiping. Okay. So we can put limits on ourselves. And delaying gratification, which is really, there's a great benefit to this, because if you save over time, it's easier to save if you know I'm putting that money there so that I'm in Jamaica next spring, period. Or I'm going to fly to Portugal for Christmas this year. So it's easier to save when you have a goal for that saving, whether that goal is vacation, new car, down payment for a house. If you save for a goal, it makes it easier to save, because you're putting that in there aside for now, and you're going to win in the long run because you're going to be on the beach or in your new house or driving that new car. Now, I cannot express to you enough what good work we do at the Allegheny County Financial Empowerment Center. And as I mentioned earlier, anyone who lives in Allegheny County or slightly beyond, as long as they're over the age of 18, they are eligible for our absolutely positively free services. And the way that we kind of work is that the counselors, and I am one of them, we kind of look at the whole picture. Most of us, including myself, when you have a particular issue that's bothering you, we have blinders to the big picture. Okay. So we kind of help you kind of back up, look at the big picture, look through options, whether it's, I need help with my electric bill. Can you tell me how to save to buy a house? All that kind of stuff. My credit's killing me. Collecting agencies are calling me. We can help you look at the options. And there are a lot of options that, as counselors, we know about: talking points with collections agency, negotiating settlements. There's a right way and a wrong way. But once you identify your goals, we'll work with you until you get there. Whether your goal is, I need help building a budget, or if it's a big goal, I'm going to start a business and get a grant for that. I always say that the FEC, the counselors, are the GPS system. As individuals, your hands are on the wheel. We are just next to you saying, why don't we try this? Why don't we try that? and give you encouragement and factual information, which is an important point because there's a lot of bad information out there, but that's our job. So here's a quick snapshot of the staff. Amber's the manager and Christian works behind the scenes. Akuma and Alicia. Also listed here are the sites where we work. We each work in an actual building 2 days a week, and the remainder of the time we work from home, but 5 days a week we can do video calls, phone call appointments, or in-person appointments. So our sites are listed here as well. That's me in the middle. I'm in Mount Olive Wren and Turtle Creek. And I think that we're going to be changing the way that where some of our services are. But we do have, not only are we all certified by the National Association of Certified Credit Counselors, we all have individual certifications on student loans, home ownership, credit disputes, all that kind of stuff. So we can help you really with just about any of these things. Our 4 main pillars are, and every goal, whether it's I want to build a budget, send a kid to college, or start a business, we help you talk about building savings, reducing debt, improving your credit, and working and finding the right bank account. Everything is confidential that we discuss. When you walk out the door with a copy of your credit report, that report's not shared with anybody else. We're an accountability partner. We have resource referrals. I could go on and on about that too. But instead, what I will do is I will stop and see if anyone has any questions. I hope that you do.
We had one question that was on the registration form. How can someone save and still maintain their benefits?
Oh, that's a great question. Okay, so for those of you who are not real clear about what that means, is that for certain, like SNAP benefits, you were not able to save more than $2,000 for risk of losing those. So first of all, those benefits amounts are readjusted every year. Okay, and the income guidelines are readjusted every year. But there are also other programs in place that just a whole lot of folks don't know about. There's a program called the PA ABLE program for folks with disabilities, where you can save an unlimited amount of money. The other thing too is if you save smartly and in certain areas, some savings don't count against that. So for example, if you want to purchase a home and you need to save for a down payment, there are some down payment programs that have matched savings accounts where for every dollar you save, they match $3 for that, for first-time home buyers and things along those lines. But really what it boils down to is checking, depending upon the benefit, checking with your caseworkers, making sure that you're clear about what those numbers are, because I've had people get in trouble. I've had folks on Social Security disability who wanted to just work a little part-time job, and they said, just don't make more than X amount. And one paycheck she went over and she lost Social Security. It took her 4 months for it to come back. So, keep in check with your caseworkers, but there are programs that enable you to do that. Okay, so Doreen, you asked a question about not spending more than 30%. So if we're talking about 30% of the credit reports, right, of your credit limit. Okay, so here's how it goes again. Now, and I promise I'm going to answer the question, but remember the finish line means we pay the credit cards off, but let's aim to get them down to 30. Okay, so let's say your credit card limit is $2,500, and I think I might be reversed. Alrighty, I apologize. So if your limit of your credit card is $2,500, no matter what the current balance is, what you want to do is make sure you get times 0.30, and that's going to tell you that 30% of 2,500 is $750. Now, I will say, I help folks with these charts all the time. And actually, there's a self-populating chart that I share with a lot of my clients too. If somebody's got like a $12,000 credit card and or 12,500, I've seen a lot of those lately, and their balance is like really high. If they're close to maxing it out, I always say, let's do baby steps. So if you've got a $12,500 limit card, I say, okay, let's aim to pay it down to 70%. And the way you change a percentage to a decibel is just move it over 2 places. So 70%, I'm sorry, of 12,500 times 0.70. So for some people, I say, okay, let's just get it down to 70%, which is 8,750. And then 50%, 30% until you can pay it off. And sometimes when a real estate sorry, credit reporting bureau, when they see that you're paying your card down aggressively, sometimes Visa will see that and they'll say, oh no, Regina's not charging anymore. We're not going to make any more money off of her. They'll go ahead and increase your credit limit, which is, they're doing you a favor, because if you're paying it down and then they increase the limit, you might drop below 30 that fast. But remember, they're not doing you a favor. They're trying to bring you back so you spend more. Okay. So yeah, that's the way that particular chart works. But again, ideally, and for some reason, I know I get caught up in the numbers. We want to build a pay down chart, knock off the things that cost us the most, but definitively, without a doubt, put a chunk of money into savings. All right. Because it's better to save and think of your pockets of savings. Save for vacation, save for the new car. How about saving for Christmas? When I was a kid 150 years ago, they had what were called Christmas Club accounts. You'd put $25 a month into that account, and it would build up throughout the course of the year. So if I'm putting $25 into an account for the full year, by December, there's $300. And it's like, okay, pluck it out. There's my Christmas shopping. So you start to save for these things so that you break the cycle of spending and then running to pay it off when you have your tax refund in hand. So saving is like such a crucial component of all of this that I would recommend, no matter how big your tax refund is, by all means, pay down debt, by all means, but use some of it as a good point to kickstart a savings program as well. Katie, I think that I'm going to turn it back over to you so you can fill any more questions, but to see if you wanted to add anything to this and talk about the VITA program, perhaps.
Sure. So obviously the first step to be able to get a tax refund is we have to file our taxes for the year. So my agency is partnered with about 20 other sites throughout Southwestern Pennsylvania where we provide free tax preparation services so that you can file your federal, state, and local taxes. You don't have to pay us anything. It can be real expensive to file your taxes if you're not using a VITA site. If you are the only person on your tax return, you might qualify if you made under $45,000 last year. If there's at least 2 people on your return, whether you're married filing together, you're a parent or guardian with a dependent, you can make up to $65,000 and you might qualify. Now, this is just personal income taxes, can't do businesses. And there are some situations where, depending the tax form that you have, you might not qualify for the program because the IRS tries to have us do just pretty much simple tax returns. But our site is open Tuesdays and Wednesdays. We have morning, afternoon, and evening appointments. Like I said, we're partnered with about 20 other sites throughout this area. So if you are only off on Fridays, there is someone who is open on Fridays and can help you. To schedule an appointment, it's all the same no matter what site you go to. Call 211, which is the United Way's helpline. Tell them you want to schedule taxes. They may ask if there's a certain day you're available or a certain day of the week, and they will match you with a site. So my site is located in Turtle Creek. We're called the Human Services Center Mon Valley. We would love to have you come in because obviously you're attending one of our webinars, but if you use one of our partners, I'm not offended if you go somewhere else, but we'll help you know what taxes or tax credits you qualify for. Make sure you get the whole refund that you're due. And on the off chance, if you owe money, we can help you figure out why that was and how to pay that to the IRS. But please make use of the free service. You can literally save a couple $100s just in filing fees if you come to visit us, and we are happy to help you file your taxes then. And that follow-up email that I send will have a flyer with all of that information, even a list of like what documents you need to bring with you. If you have any questions, feel free to reach out and let me know because we want to make tax filing as easy as it can be. Yep.
And Katie, I may not have said it enough, but if anyone's interested in any follow-up, our website is myfinancialpower.org, which is a new website than what we had this time last year. But our website you can look at all the counselors, read our bios, pick the one that's the best fit for you and works at a location and has availability that works. And we refer everybody to use VITA because why spend money if you don't have to?
Yeah.
Really.
I'll make sure that email is in our follow-up, or your website is in our follow-up email for sure. Regina's at our site on Wednesdays if you want to go in person. Um, I'm also going to be a client starting tomorrow. I'm going to use the FEC. Even though I teach this stuff, there is a chance for everyone to learn something. So please make use of that because it is a great free service in our area.